I just got kind of fascinated about 10 years ago by high-frequency trading, and that's the topic of the book. And by high-frequency trading, I mean proprietary trading, where the alpha, where the profitability inherently depends upon speed. Started to get interested in its history, started to get interested in how people do it, and somewhat to my surprise, I found quite a number of people who were willing to help me and explain it all to me. The first of all, and these two things are actually connected, the first one is I kind of expected that everything would be very idiosyncratic, that people would have secret sauce that they really didn't want to talk about, that there would be lots of use of sophisticated machine learning, and the like, and it was going to be hard to get underneath the hood, so to speak. What I discovered, though, is that there's a lot of common knowledge in high-frequency trading, a lot of stuff that everybody knows, and everybody knows that everybody knows. So people were prepared to talk about that kind of thing. And then the second thing, which is related to it, is that if your algorithms are reacting to a signal that is common knowledge, then of course you know that all sorts of other algorithms will also be reacting to the same signal. And that means that the business is a kind of speed race. At the very heart of it, there's speed races. So I'd say those are the two main things I found. The extremity of the speed race, that, you know, the figure that I've had quoted to me is an algorithm's reaction time of 42 nanoseconds. And that's mind-boggling, because a nanosecond is a billionth of a second. And in a nanosecond, the fastest possible signal, light in free space, travels only 30 centimeters. It travels only, you know, like a foot. So that is an astonishing kind of speed. So I think that really struck me. Equities, futures, treasuries, and spot foreign exchange. By no means all of them coming off the trading floors. I mean, some of them were set up by people with PhDs in quantitative kind of subjects, but that seems to be dominant kind of organizational form, so to speak, in high frequency trading. I mean, you do get firms that are configured, such as Citadel, that is a hedge fund, but most of the firms are the classic prop shops. I decided that for practical reasons, I was going to concentrate only on Europe and United States. So I didn't attempt to speak to people in Asia. And essentially, though there are some outliers, that means 4 cities: Chicago, New York, Amsterdam, London. The one that I did before this that was my favorite until I did this one was a book called Inventing Accuracy. And that was a history of nuclear missile guidance technology. And it had some kind of similarities, because I again started thinking that was going to be a hard area to get into, and nobody was going to be able to really talk to me about anything meaningful. And I found, well, if you just try, if you reach out to people, ask them questions, surprisingly often they will speak to you, and you can work on topics that you don't think you're going to be able to work on. What you would define as the first high-frequency trading firm depends quite a bit on how exactly you define it. And of course, speed has been important in trading for centuries. So in a certain sense, none of it is entirely new. But the oldest firm that I spent a substantial amount of time working on was a firm called Automated Trading Desk, set up in Charleston, South Carolina, way back at the end of the 1980s, if I remember correctly. It did its first trading in 1989. And of course, everything was slow by modern standards, but they were working in the style that has become high-frequency trading. Oh, yeah. I mean, because that's a sine qua non of high-frequency trading these days. You know, by around 2002, people were starting to do it. There's a very important, well, it's not exactly an exchange. It was an ECN, an electronic communications network, an electronic share trading venue called Island, set up in the middle of the 1990s. And by around 2002, they had their offices in Broad Street in Lower Manhattan. The computer room was in the basement of Broad Street. And by around 2002, trading firms were starting to move their servers into that basement to be right beside Island's matching engines. And I got started, of course, what fast meant was fiber optic cable. And the spread networks, the famous new direct spread networks cable from Chicago to northern New Jersey had just come into operation. And that seemed it. That seemed like, oh, that's the state of the art. And then I kept hearing these rumors about the use of microwave transmission. And to begin with, I didn't believe it because microwaves, hey, I kind of knew, you know, they're vulnerable to rain and stuff like that. It seemed like a step backwards. But what I hadn't reckoned on is that light in a fiber optic cable gets slowed to something like 2/3 of the speed of light in a vacuum, whereas if you send a signal through the atmosphere, you're going at almost the speed of light in a vacuum. So absolutely, fast now means microwave transmission, certainly when you're dealing with distances such as Chicago to New Jersey. You know, one of the academic ideas that I play around with is the idea of material politics, or what I would probably rather call material political economy. And what that essentially boils down to is that you can arrange technical systems in different ways, and some of those ways advantage some players and disadvantage others. So that's why there's politics, so to speak, in how the material world is configured. And that's what speed bumps do. They advantage some players and disadvantage others, particularly less so in a sense with the IEX speed bump, but with what people call asymmetric speed bumps that slow down one category of algorithm more than another category of algorithm. That's an attempt to shape the playing field, so to speak, to advantage one kind of algorithm and disadvantage other kind of algorithms. I don't take a pro or anti view on speed bumps, but I'm fascinated by them as I said, a kind of form of what I would call material politics. You can get a trading algorithm that is at a sort of, it's a kind of trigger point. It's just tiny little movements in the market cause it to flip from one price to another price. So it's constantly cancelling orders and sending in new orders. And it looks for sure like quote stuffing, but actually it's a glitch. It's, you know, a bit of programming. It's pretty hard to program an algorithm so that doesn't ever happen. So that's not, I think, it wouldn't be, to my mind, something that you would expect to encounter a lot of. Something like spoofing, I think, has been a much bigger and more real issue than quote stuffing. No, I don't. I absolutely don't. And one of the things that I've watched happen over the 10 years I've been working on the book is I've watched firms disappear Where's Getco? Where's Chopper? Where's Teza? Where's Infinium? Where's Sun? Where's RGM? The business is consolidating, has been consolidating quite fast. I don't quite know what the exact figure is. The Financial Times suggests that 40% of all US equities trading volume is now handled by two firms, Virtu and Citadel. And Gary Gensler has actually said something broadly similar in recent weeks. Part of that is to do with the fact that if you have a speed race, then there are going to be winners and there are going to be losers. And keeping up is a horrendously expensive business. Now, that's not to say that there aren't things that a new little firm might not be able to do. They might be able to find a niche. They might have a real good trading idea and so on. But the classic high frequency trading game, the speed kind of game, you would be very naive, I think, to go into that unless you had hundreds of millions of dollars to spend. And alas, I don't. A couple of things. One is to think carefully about the nature of the technical systems, particularly of exchanges' technical systems, because a thing that sounds really minor and technical is jitter. It's random fluctuation in processing time in exchanges' computer systems. And that used to be quite bad, and it's got a whole lot better. The systems have become a lot less jittery. And of course, that's technical progress, but it can have anti-competitive effects, because if the system's jittery, then sometimes the second fastest firm gets the trade, maybe even the 10th fastest firm gets the trade. So competition stays alive. As the systems become less jittery, then speed races tend more and more to have the same winner time and time again. So I think if I was sitting where Gary Gensler is sitting, I would say, think carefully about what's necessary to keep competition alive in the area of trading. And then secondly, and the two things are interrelated, how are you going to stop trading being sucked away from the public market into private wholesale arrangements in terms of retail trading, into bilateral relationships between high-frequency trading firms and investment houses and banks and so on? I mean, arrangements in many ways are fine and make complete sense for the people directly involved, but they suck liquidity out of the markets that are the primary price discovery markets. So there'll come a point where the prices formed in those markets, which are precisely the kind of prices that are then used in the private relationships, those prices stop being so informative. Not yet very close, I think. And of course, it would be the kind of job, I'm not an economist, it would be a kind of modeling sort of job to work out the kind of threshold value, perhaps, at which, if public markets shrink below 60% of trading, or shrink below 50% of trading, or shrink below 40% of trading, then things start to go wrong. But what are we at in equities? Something like 30% at least of volume being executed off exchange in one form or another. We might not be too far away from that kind of situation where the public markets stop being the primary places of price discovery. A properly policed dark pool, and of course historically they haven't all been properly policed, but a properly policed dark pool probably makes complete sense for a big institutional investor trying to do a big trade. So privately, a dark pool can make complete sense. But of course, if everybody goes dark pool, then there's no volume in the lit. So once again, the public markets are losing their price discovery function. I would like regulators to read it. I would actually like traders themselves to read it. I hope, if nothing else, that they would learn something about the history of the activity, something about how we got to electronic markets. So I would hope they would read it. I would kind of hope that the interested member of the general public would read it, because, of course, markets are important to the economic systems of Europe, North America, much of the rest of the world, and so on. So it's a kind of good idea for the educated person to have some idea of how markets work, and not to be misled by the kind of stuff that happens, because if something big happens in the stock market and you're watching the TV news, they will still try and show you a picture of a trader in a colored jacket, typically looking despondent if the markets have gone down. And, so there's still a little bit of that left. That's not really what markets are like these days. So I think we're going to be making bad decisions about markets if that remains our mental image of what a market is. It's about how commonplace speed races are. So there's a wonderful piece of work by the Chicago economist Eric Budish with a couple of folks at the Financial Conduct Authority in the UK. And they got hold, and because the Financial Conduct Authority was involved, this is how it happened. They got hold of messaging data from the London Stock Exchange. And you need messaging data to identify speed races. You can't do it with standard order book data. And what they found was that the average stock in the FTSE 100 index experiences a speed race about once a minute, on average, every minute of the trading day. So the speed races of HFT are commonplace kind of things. This is a feature of how the markets currently are configured. And that's a very important datum. I think that's, I wish I'd discovered it myself, but I take off my hat to Eric Budish and to his colleagues for that wonderful piece of work.